This section is pretty straightforward. It's not complicated. However, it requires more discipline than our short-term strategy. Short-term strategy, we don't need much discipline. Our risk management is pretty tight. The biggest hurdle for some people when it comes to long-term investing is the inevitable fluctuations, dips in your account, which can cause some people to believe that they're just not natural investors. I believe most of us are natural investors because we can all appreciate and recognize value. We just need to flip this thinking to the stock market. Let me show you what I mean. You're looking at a chart right now of the Dow Jones Industrial Index, pretty much the stock market since 1910. And in red, you see all these crisis periods, all these times when people may have even felt maybe vindicated for not investing in the stock market. They're saying, yeah, the stock market went down. That's why I don't invest in the stock market. But notice how America really is what you're dealing with here, always rebounds. So as I'm recording this course right now, the stock market is hitting new highs, meaning that if you invested for the first time last week, you're up. If you invested for the first time 5 years ago, you're up. 20 years, 30 years, you're up. That's the moral of the story. But let's pretend that you missed this entire run-up of the stock market over the years. There's good news. You've been given 3 opportunities to go back in time and invest 3 equal lump sum payments into the stock market. For the past 30 years, it's an open book test. This is the only time I'll pull out my crystal ball to predict which time frames you may choose. Let me say, you'll maybe choose to invest after the dot-com bubble burst around 2001, maybe the global financial crisis, the real estate crash of 2008, the COVID crash of 2020. All 3 were catastrophic events. I want to be clear that given a choice, I would rather not have these opportunities to add more money into the stock market, not under these circumstances. But the fact is, these events create huge value opportunities for us to add to our long-term investments. Because ultimately, I don't consider what we're doing investing in the stock market per se. We're investing in America's leading companies through diversified, low-cost ETFs and index funds. Also, I'm not suggesting that if you're brand new to the markets, that you should be all in on the stock market. We should all have a balanced mix of investments based on our own personal tolerance for risk. The more you're educated on the markets, the more your risk tolerance will increase. It can be no other way. It should be no other way. Initially, it's common to have a long-term portfolio that may have an almost equal weighting of bonds and stocks if you're risk averse, and there's nothing wrong with that. So just to be crystal clear on why we allocate a larger portion of our liquid assets to a long-term strategy, the history of the stock market is irrefutable. If you have at least a 20-year time horizon, there isn't a single instance in which the stock market had a negative return. Even with the 10-year time horizon, the largest drop you would have experienced is just a little over 4%. And if you look at the 1-year drawdown, it's like, 37%? This is the reason retail investors should never attempt to buy and hold with a time horizon that's less than 5 years. Less than 5 years, you need to learn how to manage your money with a major focus on risk management, which is what you've done by taking this course. You've learned the skills necessary to avoid that trap. But moving on.